So today we'll discuss few things, cash flow analysis for the taxation, and this is the last one of this session. So we will see today cash flow analysis, operating, investing and financing activities, and direct and indirect method of cash flow. Just for basic understanding, we know that cash flow statement is a financial statement that summarizes the amount of cash and cash equivalent entering that means cash inflow outflow is the summation. So here we can see from the income statement, here our revenue, if we minus the expense, then we'll get net income, and from that net income a statement of retained earnings, where from that net income after the tax, if we distribute dividend, then that's go to the retained earnings. The owner of the retained earnings is total equity participant or equity shareholder or ordinary shareholder. They are the real owner of the company. So that amount go to the retained earnings, and from that retained earnings, if we see the cash flow, when cash at the beginning of the period, and we should adjust cash inflow outflow within that beginning cash inflow, beginning cash balance, and at the year end or period end getting the cash closing balance, that balance we directly go to the balance sheet as in cash and cash equivalent, and through this way, and any adjustment is come to through three side. One is operating activities, one is investing activities, another one is financing activities. So the cash flow statement measure how well a company means its cash position, meaning how well the company generate cash to pay its debt obligation, and fund is through the operating expenses. If we see the example of different activities of cash inflow, it's taken from the International Accounting Standard 7, IS 7. So IS 7 totally for the cash flow statement. So here we know there are three activities. So one is operating activities, another in investing activities, another in financing activities. So operating activities, if you see here the cash received from the sale of goods or our service. For example, we are in tax practitioner, so our cash received from the service, that means not for the selling the goods. So that service that we will get the amount, that cash inflow through the rendering the service, and also sometimes royalty, fee, commission, and other also the cash receipt. And payment when the manufacturing organization, we are payment to our supplier for purchasing the material, for the goods and service, and also for our company's administrative expenses, for example, employee salaries, manager salaries, and other item. For example, that means sometimes some receipt payment can come, and insurance entry, insurance premium, income tax, other thing, that type of cash inflow outflow can be happening. And if we see the investing activities, from the cash received, how? Sale of PPE, that means property, plant and equipment. There's the fixed item, that means our where we are investing our machine, our building, the different types of item, we have to establish it for the organization for running the business. So if we sell it, then it is not general selling, it is the only for the capital expenditure and capital investment also. So this capital for the expense of that we sale of the capital item, we will get also the money. So that is comes from the investing activities. And intangible and other long-term asset also, we can sell the equity or debt instrument, for example, our that means bond, share, etc., and other entity for the investing purpose, an entity for joint venture, and also cash advance and loan from taking from the bank for investing purpose is also our cash inflow in investing activities. Same way cash payment, when we want to purchase machine, building, other item for running our business, it is the cash payment for capital expenditure. And acquire, for example, if we invest in capital market or purchase any share or debenture from another market, but this is not our regular activity, it is not operating activity, so that investing activity also we have to pay the amount, so it is the cash outflow from the investing side. And cash advance and loan made to the party, it also the investing. And if we see the financing activity, how bring money to the company for running the business. So cash receipt, that is the inflow, comes issuing of share. This is the fundamental thing. Ordinary share or equity share, if we issue, then we will get the money. It's for the financing activity, that finance for running the business. So equity instrument and also sometimes preference share, etc. we can issue. And issuing a debenture, loan, notes, bond, mortgage, etc., for collecting the money as a capital. We know there are different types of capital. One is equity capital, another is loan capital. So this bond, loan, note, etc. comes from our that type of capital. So we also have to pay from the financing activity, owners who acquire the redemption entity share. For example, if we collect money from the issuing the preference share for the 10 years, 5%, 10% or 9%, then after 10 years, that amount have to be paid. And also same way, our bond, debenture, etc. Also, if we take money from the bank, we have to pay the amount. We have to pay the installment, we have to pay the interest, all things have to pay from the financing activity. So all summary is come to the financial statement, that means a statement of cash flow. And that statement of cash flow is describing IS 7, International Accounting 7, and we know International Accounting Standard is a prescribed rule for the finance guy. And also this is why IS 7 comes. It is the accurate to present of information about the historical change in cash and cash equivalent of an entity or organization by means of a statement of cash flow, which classified cash flow during the period according to the operating, investing, and financing. As per the IS 7, there are three sections we know. One is operating. So what is operating? Objective of the company, our mission, vision of the company, whose purpose establish the company, that activity is the operating activity. The principal revenue generation activities of an organization and other activity that are not investing in financing. And any other cash flow, current or asset or liability comes operating activity. So, and financing activity, we know any cash flow from the acquiring asset, disposal of the asset, for the long time, it's investing activities. And financing, how company will be able to run, that's when we collect the money for the capital purpose, that is the financing. That financing can be equity financing, that financing can be debt financing, collecting the bond, stock, etc. So this is the fundamental scenario from the income statement to balance sheet and cash flow, how the item go from one step to another step. For example, income statement, here sale revenue, here if sale growth, then profit of ratio cost of sale if less, then profit will be maximized and earnings will be high. And this comes to the stock turnover. If you look here in the balance sheet, that from the sales side we will get the receive money from the for selling the debt. That means we will get the money from the receivable. That money also go to the cash flow. So this is the parameter of it's also this scenario from the software algorithm also. So they are doing this way the work. Why we learn and understand the cash flow statement? why we learn the cash flow statement? We know knowledge of cash inflow outflow. We have to understand the cash inflow outflow, knowledge of trading profit. What is trading profit? And knowledge of increase decrease share capital. We know, and because we have to understand, because purchase of sale fixed asset, and we have to understand the increase decrease of long-term loan. We have to understand increase decrease cash balance. We have to understand the tax and dividend paid. So that's why we have to learn the cash flow, because this statement is very useful to know the amount who is actually paid for tax purpose or dividend. For example, we are adjusting tax in different way. If we issue bond, if we issue debenture, if we take loan from the bank, and the effective rate, for example, 9% is a bank interest, but effective when we go for the decision making, effective rate where if tax rate is 30%, then 2.7% should be less from the 9%. So for decision making, because that interest as an allowable expense to the DCT, that's why when we go for the any decision, we have to adjust with we have to calculate the effective rate for proper decision making. So that's why we have to understand the cash flow. So that cash flow we can calculate in two methods. One is direct method, another is indirect method. Basically, that method applicable only for the operating activities purpose. Another two activities, for example, that means our investing and financing, there is no method applicable, all are the same, but only applicable in the direct or indirect method within the operating activities. That's why if you see the Securities and Exchange Commission circulated, or they have the rules that all listed companies should prepare their cash flow through the direct method and disseminate the information this way. That means operating cash flow per share, they should disseminate the information for the investor for proper decision making. So a method and enterprise can determine cash flow from operating activity using only direct and indirect. So direct method is that. The direct method where major classes of gross cash receipt and gross cash payment are considered. Only from operating side, how much money we receive and how much money we paid directly reflect in the direct method. And indirect method is that the indirect method where net profit or loss, because we know the indirect method, we start from the net profit or loss from the profit and loss account. So profit and loss account balance would be the first item, and we should adjust from that figure non-cash item, for example depreciation, amortization, other thing we should adjust with that figure, because that we calculate net profit, but within that net profit they are included in the depreciation, but depreciation is a non-cash item. But because depreciation, no cash outflow from the depreciation, but that depreciation is allowable expense and we calculate as an expense, we show it in our profit and loss account, and that's why that should adjust with the profit and loss account and upon calculating the cash flow. So this is the indirect method. We will see the math. Look here cash flow statement, we are calculating indirect method. If we see the following are the summarized financial statement of FA, we know what is the position. A statement of financial position means balance sheet and a specific date, that means 31st December, the position of balance sheet is that, the position of the company is that. So this figure here, a few items, cash, debtors, stock, fixed asset. So total in 2020, 2,14,000. In 19, 1,90,000. And if you see the liability, share capital 32,500, 6% debenture, but debenture due 31st December 22, 50,000, Retained earnings balance 38,500. Creditors 20,000. Income tax payable not paid yet 36,000. Accumulated depreciation 37,000. So we know what is the accumulated depreciation. This is the fixed asset at cost. So total amount of fixed asset is here in the balance sheet, and each and every year we are calculating the depreciation and charging in the profit and loss account. So that accumulated figure is there here, 37,000. Real fixed asset value is, if we minus 37,000 from the 1,20,000, then we'll get the actual fixed asset price or cost value of this as per cost at this moment. But here showing the total at cost, how much money paid from the purchasing time. And if we see the income statement, we know that what is the income statement. Income statement provide us the profit and loss, how much money we are earning, how much money we paid, and where go for the money that sell. 4,25,000. Operating expense including depreciation 10,000. 3,40,000. Interest on debenture 3,000. Net profit before tax 2,000, and income tax is 36,000. Total balance 46,000. And a statement of retained earnings, 2 years. Retained earnings beginning, retained earnings, this one 27,500 beginning. That means it is the closing of 2019. That is the beginning of 2001. That means that beginning of the 2020, this one. And net profit for the year 46,000 come from this figure. This 46,000 is this 46,000, total 73,500. And from that amount paid the dividend. So look here, this dividend is not shown in the income statement, but in income statement we have to show the preference dividend. But real dividend, that means paid to the equity shareholder, that's distributed from the retained earnings. So from that retained earnings balance, distribute 35,000 to the equity shareholder or ordinary shareholder. So retained earnings closing balance is 38,500. So this is the 3 statement of that company, and from that statement we have to prepare the cash flow statement in the indirect method, because here statement, income statement balance is 46,000. So indirect statement we have to tax 36,000 not yet paid. That means not yet paid this tax, because that means if we paid it, then we have to pay through the our cash flow. Our cash flow will be less. So here that statement start from 82,000. Why 82,000? Because that 36,000 not yet paid, we have to pay it, not yet cash outflow. So start from 82,000. If it paid, then we have to start 46,000. So here start 82,000. Change in working capital, how change? Decrease in debtors. If we go the balance sheet to debtors, in the year 2019, debtors were 31,000, but debtor decrease. It means that they paid the money to the company. So in the year 19, it was 31,000, but 20 closing balance 25,000. So it means that the difference of this amount we collect from the debtors. So that would be the positive thing for adding. Look here, so this one, so we can take the amount within the bracket, that is 6,000 we collect from the debtors. Decrease in creditors. Look here, creditors in our creditor, it was 12,500 creditors. We have to pay the creditors, and that creditors increase. So difference means that we do not pay the money to the creditors. So increase the creditors. Increase the creditors. So that amount also add here. And depreciation amount 10,000. as calculated said in the income statement, operating expense include depreciation 10,000. Within this 3,40,000, 10,000 is depreciation as shown in the profit and loss account, but this 10,000 do not cash out from the company, so that 10,000 add here. So there is adding thing is that 23,500 increase in a stock. Look here, if we saw debtors stock increase, that means stock was 45,000, now 60,000. It means that we paid the money and purchased the stock. So difference is that minus 15,000, difference both amount. So if we adjust 23,500 and a stock amount 15,000, then we will get 8,500 is a positive, and this comes from the operating activity because all thing, look here, debtors. Why debtors? We sell, so increase the debtors. We purchase material, so here increase the creditors. We take the stock, so here decrease the amount. So it's all related with the operating activities. So this amount equivalent is the cash provided by the operating activity, balance 90,500. So here again tax paid 27,500 comes here. Last year tax 27,500 paid in 2020. So this amount adjust with the operating side. So after adjusting, because tax come from the operation, so after adjusting last year income tax, we get the net cash provided operating activities within this 2020. So operating is 63,000. This 63,000 taka is come from the operating activity for the year 2020, and this is one part we completed. So it is the cash flow for indirect method that beginning from the balance of profit and loss account. And then another two item, cash flow from investing activities. So purchase of fixed asset 15,000. So this 15,000 how comes here? Look here, this fixed asset balance in the year of 2020 1,20,000, but it was 2019 1,05,000. So different the both amount 15,000. Here also said fixed asset at cost. So it is the cost value of fixed asset here. So 15,000 cash purchase for the investing side. So this 15,000 only minus 1. There is no positive thing, only just cash outflow is 15,000. So only one item in investing activities. And number 3, cash flow from financing activity. So how come? There's issue of share 1,000, redemption of debenture 20,000, dividend paid 35,000, net cash provided financing activity 54,000 is minus. So this amount how come? The issue of share capital. Look here, balance of share capital in the year 19 31,500, but share capital in the year 2020 32,500. So difference is 1,000. That means that 1,000 share issued within year 2020 through taking the money. It is the positive thing. And debenture 6% debenture, here 70,000 was balance in the 19, but 50,000 in the year 20. So 20,000 debenture redemption, that means paid the amount. So it is the minus 1. So this minus 1 is considering here, this 20,000. And now dividend paid 35,000. So dividend we have seen here, dividend 36. This one, so here what's 30? This 35,000 dividend paid. This dividend paid to the shareholders. This is the financing activity. Amount money collect from the shareholder, and all activity with the share within the shareholder is goes for the investing activity. So balancing is 54,000 minus. So here net cash flow from all activity. One is operating 63,000 positive, another investing 15,000 minus, and third one financing 54,000 minus. So adding all thing, total item is 6,000 minus of our total activities. And at opening balance was 15,000, so closing balance 9,000. These two items will be reflected in the balance sheet. Here, cash. In the year 19, closing balance was 15,000, but 20 closing balance is 9,000. So this 15,000, 9,000 issue is here. So it is the cash flow. And if we see another one, direct method. Previously we have seen the indirect method, now the direct method.